if you had your choice over a German Bund or a French Oat or whatever, the Italian sovereign, any other EU country, you would much rather have the German, and that's why their bonds trade at a premium for all euro-denominated debt. The white line on this chart is the aggregate balance sheet, total assets in the German banking system. And then the left is that same chart we saw in that prior slide we were reviewing on total German Bund debt securities outstanding. And you can see, I could zoom in, show the correlation better, but basically what you see, kind of two different eras. From 2000 up until the European debt crisis in 2011, 2012, you saw German debt increasing, right? And then starting in the the EU debt crisis, the pig situation, if you will, which ECB has now said you're not supposed to call it pigs anymore. That's terrible marketing. I don't know what else we're supposed to call it. The 2011-2012 EU debt crisis, we'll call it that. German Bunds started, the supply, they started pulling back. They started declining. Like forced austerity started kicking in, all this stuff. Decisions were made under Chancellor Merkel and kind of that era's government. And then 2019, 2020, you saw the German debt issuance kind of pick up again in response to both the economic slowdown, the global economic slowdown that was materializing, especially in half two of 2019, but then with COVID showing up on the scene, stepping on the gas maybe a little bit more. Now, the German sovereign debt, step up was nowhere near the degree that the U.S. government and the Fed stepped in as to bail out the rest of the world in the dollar system. But still, you can see when German Bunds are expanding, basically supply, German banks are expanding their balance sheets. What that means is they're creating more credit. They're lending into the German economy, or equivalent, you could be saying they're creating money, right? A credit-based money. There's more monetary supply available. And if we go through this situation where the German political consensus decides not just to keep increasing Bund supply, but to actually increase by an incremental $1 trillion over the next 10 years, what you're essentially going to do, what you'll essentially see here, by taking Bund supply up, banks are going to ratchet up their supply of credit into the economy, plus all the savings that's going to come in from households and private businesses, et cetera, the private sector, with the Savings and Investment Union plan, if that goes through. That's going to be a massive credit impulse in the EU economy. What does credit impulse translate into? Higher nominal GDP, economic growth. Now, the key here in terms of are you creating a bubble or just a financial asset bubble or real economic value? From an Austrian perspective, credit creation that's funding by savings is the actual key. So if the government is just creating more and more debt and not doing anything to increase savings to fund it, that ultimately leads to very similar situations to what we've seen in the U.S. Let's just call it that, where you just get more financial asset appreciation, but your real economy, private actors, just start doing or start allocating time and resources into non-economic things like NFTs or OnlyFans, just not productive economic activity. Let's just say that. So the key thing here is getting German savings or EU savings to fund this credit expansion. And I think the answer actually is the approach with the Savings and Investment Union is, well, we already have the savings. We just need to unleash the Kraken is kind of the take. So basically what this is we're looking at a 2x potential increase in the growth rate of German banks' balance sheet expansion. Now, what that translates once that crosses borders in the EU, this is where you'd have to do a lot of modeling to figure that out. But I can tell you this, directionally, it should be a credit impulse in the economy. And kind of the first move when, as George Soros says, what's the first thing you do when you identify a bubble or a credit bubble? You bid, you own it, right? You want to be the first into a bubble. And that's, from my framework, what's really driving a lot of the behavior we're seeing in capital being pulled out of the U.S. The U.S. bubble's not cool anymore. Mag 7, sorry, we've had enough of you. The hot new shiny thing right now is deploying into the EU, German industrials, EU defense companies, EU financials, things like that is kind of where global capital is seeing, hey, this is the fast money is moving into to bid the bubble as it sees, a new one potentially forming. When I use the term bubble, I do it politely. Maybe this will be economic, because as ECB makes the claim, German citizens are sitting on a lot of private savings that are just sitting in bank deposits. European corporations, same thing. That needs to be unleashed is their argument, and hey, maybe that's true. We're probably going to find out, but this has all the longevity to be, in my opinion, one of, if not the main driving financial narratives for the next decade as this is plotting out.